Switzerland, though one of the most scenic places on the earth, has not even an inch of sea coast. It is one of the most mineral poor lands on the earth. It possesses not a drop of oil to call its own, barely a bucket of coal. As for farming, its climate and topography are inhospitable to just about everything. If I tell you that it has stayed out of European wars for 300 years, chiefly because in all that time there has never been an invader who really wanted it. Yet, the Swiss are among the most richest people in the world. In per capita income, they rank in top 10. Their currency is the world's soundest. But how do the Swiss do it? They do it by being the world's cleverest investors, speculators, and gamblers. To make any kind of gain in life, you will have to risk something. The Swiss, observing all this, conclude that the sensible way to conduct one's life is not to shun risk, but to expose oneself to it deliberately. To join the game, to bet, but not in the mindless way, to bet in such a way that large gains are more likely than large losses. To bet and win. Zurich is a place in Switzerland and axioms are the rules. These timeless rules have been passed on to generations since World War I era. Let's see what we can learn from the rules that these risk-taking Swiss people left for us. This is the Better Investor, helping you achieve your financial goals and freedom from stock market investing, finance, and learning from billionaires. And these are top 5 lessons from the book, The Zurich Axioms, the rules of risk and reward used by generations of Swiss bankers. Written by Max Gunther. Lesson number 1. If you are not worried, you are not risking enough. Most psychiatrists and psychologists these days would consider tranquility is a good thing. It is the central assumption of modern psychology that mental health means above all being calm. This unexplored assumption has dominated shrinkish thought for decades. The philosophy behind the Zurich Axioms is, of course, the exact opposite. Perhaps freedom from worry is nice in some ways, but any good Swiss speculator will tell you that if your main goal in life is to escape worry, you are going to stay poor. Even when interest rates are relatively high, what is the payoff? At the beginning of the year, you give a banker $100. At the end of the year, he hands you back $109. True, the safety of your $100 capital is just about guaranteed, at least in any reputable bank in the industrialized world. Barring a major economic calamity, you aren't going to lose anything. The banker may lower the interest rate during the course of the year, but at least he won't hand you back any less than your original $100. But where is the fun? The fire, the passion? Where are the big brass bands? And where is any hope of getting rich? Frank Henry, the father of the author of this book and a renowned Swiss banker of his time, said to him, "Only half a person's energy should go into his job. The other half must go into investment and speculation." Perhaps we need tranquility too at times, but we get plenty of that at night when we sleep. Plus, on most days, another couple of hours at odd times while we are awake. 8 or 10 hours out of 24 ought to be enough. When you buy a stock, theoretically, you can lose 100%. But if you get it right, you can multiply it. There are investors who started from small sums of money and multiplied it many times. There are traders too like that. About few of them, you can read about them in one of the greatest financial classics, The Market Wizards, written by Jack Schwager. Lesson number 2. Always play for the meaningful stakes. Only bet what you can afford to lose, says the old bromide. You hear it in Las Vegas, on Wall Street, and wherever people risk money to get more money. You read it in books of investments and money management advice by conventional counselors. But what is an amount that you can afford to lose? Most would define it as an amount which, if I lose it, I won't get hurt. Or an amount which, if I lose it, won't make any significant difference in my general financial well-being. A buck or two, in other words. $20, a few hundred. These are the kinds of money almost all middle-class people would consider loss affordable. And as a result, these are the kinds of amounts most middle class people speculate with. But consider this. If you bet $100 and double your money, you're still poor. The only way to beat the system is to play for the meaningful stakes. This doesn't mean you should bet amounts whose loss would bankrupt you. You've got to pay the rent and feed the kids, after all. But it does mean you must get over the fear of being hurt. If an amount is so small that its loss won't make any significant difference, then it isn't likely to bring you any significant gain either. The only way to win a big payoff from a small wager is to go for a long shot. You might buy a $1 lottery ticket and win $1 million, for instance. That is nice to dream about. But the odds are stacked against you. In the normal course of speculative play, you must start out with a willingness to be hurt. Bet amounts that worry you, if only a little. Some, like Jesse Livermore, bet so boldly that they could go broke with a spectacular speed. And as we have noted, Livermore did go bankrupt 4 times. His risk level was so high that it scared other speculators, even veteran ones. He estimated once that if all his speculations blew up in his face in a single great cataclysm, when the smoke cleared, he would be worth roughly half of what he had been before. That was his chosen degree of worry. Vijay Kedia, now a billionaire investor in India, says, "I still remember once I did not have 14 rupees to buy a packet of milk for my small kid because all of my money, every penny, was invested in stock market. I did borrow to feed my kid that day, but I knew the only way to get out of this rut was to go all in. In 1990s, I put all my money in the stock of Punjab tractors, which went up 3 times in next 3 years. And then I put all my money into buying shares of a cement company named ACC at a price of 300 Indian rupees. The stock did not do anything for the first year, but then next year it went up 10 times. I sold the stock at 3000 Indian rupees. I knew my kid would not have to go through life like me. I knew I had arrived, and I knew that now there is no looking back." Rakesh Jhunjhunwala, who started off his career with 5000 Indian rupees as a chartered accountant and left a wealth of multi-billion dollars behind, has said how in his initial days, when his capital was very small, he would borrow and bet all his capital on one single company and then multiply it, then bet on the next horse, and so on. He said, "It is essential to take huge risks early on, especially when you can afford to fail." Lesson number 3. Resist the allure of diversification. Diversification, the word as used in the investment community, it means spreading your money around. Spreading it thin, putting it into a lot of little speculation instead of a few big funds. The idea is safety. If 6 of your investments get nowhere, maybe 6 others will get somewhere. Most of us middle class plungers at the start of our speculative adventures have only a limited amount of capital to play with. Let's say you have 5 lakh rupees. You want to make it grow. What are you going to do with it? The conventional wisdom would say diversify, make 10 bets, 50,000 each, buy 50,000 worth of Maruti Suzuki because the auto industry looks lively. Buy 50,000 rupees of banking sector, that is rupees 25,000 in top 2 banks of the country. Put 50,000 into a floating rate FD account in case interest rate goes up. 50,000 into gold in case the bottom drops off everything, and so on. There you're covered for all kinds of eventualities. Makes you feel safe, doesn't it? Safe from just about everything, including the danger of getting wealthy. As you see it, diversification has 3 major flaws. Number 1. It forces you to violate the precept that you should always play for the meaningful stakes. If your entire starting capital is itself not very meaningful, diversifying is only going to make things worse. The more you diversify, the smaller your speculations get. Carry it to the extremes, and you can end with amounts that are really quite trivial. As we observed under, a hefty gain on a small amount leaves you just about where you started, still poor. Number 2. By diversifying, you create a situation in which gains and losses are likely to cancel out each other, leaving you exactly where you began. at point zero. Number 3. By diversifying, you become a juggler trying to keep too many balls running in the air all at once. The more speculations you get into, the more time and study they will require. You can become hopelessly confused when things go wrong, which is inevitable as you are surely aware. You can be driven to near panic as one problem after another presents itself. When you think about these three major flaws of diversification and weigh them against its single advantage, safety, it begins not to look so good. Lesson number 4. When the ship starts to sink, don't pray. Jump. The first 3 lessons were all about what to do when things are going right. This lesson is all about saving yourself when they go wrong. And they surely will go wrong. You can depend on it. You can expect that roughly half your speculative ventures will turn sour before you have reached your pre-planned ending positions. Half your guesses about the future will be wrong, half your judgments of economic forces will be inaccurate, half the advice you hear will be bad. But cheer up, this doesn't mean you are bound to lose $1 for every dollar you gain. If that were true, the whole adventure would be pointless. It is true only of the inept. Successful gamblers and speculators handle things better. They forge ahead in large measure because they know what to do and unhesitatingly do it when the tide of events turn against them. Knowing how to get out of a bad situation may be the rarest of all speculative gifts. It is rare because it is difficult to acquire. It is an ability that separates the men and women from the boys and girls. Some say it is the most important of all the tools in a gambler's or speculator's kit. Gerard Loeb, one of the greatest stock market speculator of his time, had a rule to sell a stock if it retreated 10 to 15% from the highest price. Frank Henry said 10 to 20%. William O'Neill, the market wizard, would keep it at 8% from the purchase price. There is no one number, but you have to see the facts and decide for yourself. When the bull market ends, the hot stocks go down by 60 to even 90% in some cases, regardless of how well the company may be. Amazon's stock price plunged from $5 in 1990s to 30 cents when the bull market was over. It was only in 2010, after 10 years, that Amazon crossed that price. Look around at what's happening, study the situation, ask yourself whether the developing problem is likely to get fixed. Look for trustworthy and tangible evidence that improvement is on the way, and if you see none, take action without further delay. Jump off the ship and save yourself. With this, I am reminded of the Yes Bank saga of 2019. Yes Bank was a leading private sector bank, and after the hope was restored in financial system post the financial crisis of 2008, stock price of Yes Bank soared from 10 rupees a share to almost 350 rupees a share in next 10 years. That is 35x returns in 10 years. At one point of time, it was the company with maximum buy ratings by the analysts. However, one fine day, the can of worms was opened when the news of bad loans surfaced, and later the promoter of the bank was found in some malpractices, giving loan without due diligence and various other reasons. In next 3 months, stock price halved to close to 180. Then again, some analysts came out with the buy rating, stating that the problem is not that big and it's just about time that the stock will again go back above 300 rupees. The stock price actually bounced back on hope from 180 to 250 rupees in next 3 months. This gave people more confidence. But then in the next 10 months, stock lost 75% of its value and was quoting at 60 rupees. All this time, the new manager was put in place and he kept on touting on news channels that there are investors from America who would be funding the bank in the crisis worth many $billion. 1 week after that, ace investor, late Mr. Rakesh Jhunjhunwala, invested 87 crores at 67 rupees per share. Seeing this, the crowd became even more hopeful. But no funding came and the stock tanked to 25 rupees per share before the COVID lockdowns in the March 2020, leading to a major liquidity crisis. The bank was put on moratorium and the director of the bank sold the shares in open market, making the intraday low of 3 to 5 rupees per share. Story is enough for me to re-emphasize the importance of this axiom. It's better to cut your losses and think rationally as the ship starts to sink than be submerged in the water and hope that things would get better. Lesson number 5. Shun long-term investments. Wait, you think I made a mistake? Well, no. Don't get rooted. Every investment should be, at the very least, re-evaluated and made to justify itself afresh every 3 months or so. Keep asking yourself, would I put my money into this if it were presented to me for the first time today? Is it progressing towards the ending position I envisioned? This doesn't mean you have to keep jumping around just for the sake of jumping. But if circumstances have changed since you first got into the investment, if it is sagging, if that ending position seems to be receding instead of getting closer, if you see another opportunity that looks clearly more promising to you in the light of the changed condition, then make a move. Long-term investments, like so many of the fallacious procedures we've looked at, does have its charms. The main one is that it relieves you of the need to make frequent, perhaps painful decisions. You make just one decision, I'll buy this and sit on it, and then relax. This caters to laziness and cowardice, two traits which all of us are abundantly supplied with. Individual brokers and dealers in various speculative entities also offer what they usually call convenient sector-based monthly investment plans. They will catch a current hot sector who has gone up sharply in last couple of years, let's say defense. Paint a rosy picture and ask you to put X amount every month for the next 10 to 25 years and calculate and show you that this way with 50% CAGR you will buy a yacht in your 60s. The author says that is bullshit and short way to be poor. It's insane to commit to future about which no one knows about. In 2000, at the peak of dot-com bubble, every mutual fund company was selling you the technology fund. In 2008, everyone was selling you the real estate and infra fund. In 2009, people were selling blue chip fund. And in the peak of post-COVID boom in 2021, everyone was selling the pharma fund. And now everyone wants you to buy into defense fund or AI fund. Beware. The markets are cyclical and will eventually go into down cycle after such a sharp run. That's just the nature of it. Don't be a fool to lock yourself into something like this at the peak of the bubble from which recovering is impossible. Then there is a life insurance industry. This is a world of appalling complexity. To boil it down to its essentials, however, we can say that there are two main kinds of life insurance. Those that root you in a long-term investment and those that don't. Author's advice is shun the former. He wants you to make a commitment to invest thousands of dollars over a span of years into a far, far future. Maybe indeed the world will change in unforeseen ways and make that annuity worthless. To say it in one line, there is only one long-range financial plan you need, and that is the intention to get rich. To summarize, investment and speculation should form an integral part of everyone's life, and as per the author must be equally important as your job. However, this induces worries into lot of people. Remember, worry is a healthy sign, especially in speculation and investment. If you are not worrying, you are not risking enough. The only way to beat the system is to get a big payoff from a small wager is to play for the meaningful stakes. Don't be allured by the benefits of diversification. Diversification is good for growing the money at modest amounts without much risk, but it is terrible and almost impossible way to make it big in the investment or speculation world. When things go wrong, as they surely will, cut your losses and form a rational decision about the situation than just hoping for things to get better. Even when investing for long term, the investment must be seen afresh from time to time and its capability to grow in coming future. Don't tie yourself up to very long term decision which cannot be reversed or rethought over. That's it guys. If you enjoyed the video, please like, share and subscribe. I will come back with another video on another investing book soon. See you in the next video.